Today we're going to look at a stock that's become one of my most requested judging by people's comments. It's a relatively new company having their IPO just 2 years ago, but it already has a number of really good things going for them. For starters, it currently offers an attractive dividend yield of over 14% as of the making of this video. Over the last 2 years, they've also grown their dividend by more than 50% and have increased it for a total of 8 consecutive quarters since being founded. So today we're going to examine this company and we're going to try to determine if it might be a good holding for both an income and possibly even a dividend growth investor. The stock we're taking a look at today is Trinity Capital, ticker TRIN. They're a venture capital firm that specializes in venture debt to growth stage companies looking for loans and/or equipment financing. They describe themselves as being at the forefront of technology and innovation, providing diversified financial solutions to the global growth economy. Trinity Capital became a BDC in 2021, although according to their website, their team has been investing in businesses since 2008. According to the Sovereign Wealth Fund Institute, they're currently the 47th largest BDC, so they're much smaller than some of the big-name players in this sector. I think there's two things that are making people excited about this stock. The first thing being their performance. As of the making of this video, the S&P 500 is only up about 3.8% for the year, whereas Trinity Capital is currently up almost 21% for the year. On top of that, their stock currently offers a huge dividend yield of over 14%. If we look at their dividend history in their latest investor presentation, we can see they've been able to grow their dividend for 8 consecutive quarters. And on top of that, they've also paid supplemental, otherwise known as special dividends, and their dividend coverage was 134.8% in the fourth quarter of 2022. So although they're still a new company, they've been able to grow their dividends at a much faster rate than other BDCs in our high interest rate environment. The second reason why I think a lot of people are excited about this company is because of what Trinity Capital likes to invest in. Trinity Capital is not like your average BDC in that they don't provide financing for, I guess you could say, boring companies. They primarily invest in businesses within the tech sector, or more specifically equipment financing for startups. In this way, they're kind of similar to a handful of other BDCs out there that target these types of companies, like Triple Point Venture Growth and Hercules Capital being two examples that invest in tech and life science companies. But Trinity Capital likes to go one step beyond that in that they like to provide financing for companies that consider themselves to be disruptors, or in other words, companies that think they're going to leave a significant impact in the world. It's kind of cheesy, but that's how they describe it. On their website, they've highlighted a number of companies that they've invested in, and there's no denying that some of these are really fascinating and pretty ambitious startups. One investment they seem to be most proud of is in Axiom Space, which is a company that's developing the first commercial space station. Their plan, according to their website, is to develop and launch the successor to the International Space Station by 2031. Another company that Trinity's invested in is in a company called Emerald Cloud Lab, which is the first scientific research facility that enables scientists to conduct experiments and regular research remotely. This company's also funded some more mainstream companies like Lucid Motors and Impossible Foods. Given these things, it's understandable that there's been a lot of hype around this company, but it seems like an odd strategy to me considering that business development companies are typically pursued by people who want stable income, not high growth with increased risk. Most BDCs invest in boring sectors like financials, insurance, and healthcare services. Trinity Capital seems like they'd fare better being a private equity company than a BDC. For income investors, we typically like stability in our monthly or quarterly distributions. With this in mind, it's usually better to go after the so-called boring companies that have long track records of consistent dividend payments. But at the same time though, there's absolutely no denying that Trinity Capital's been a fantastic income investment so far. According to their fourth quarter highlights, they had $21.6 million in net interest income, which comes out to net interest income per share of 62 cents. Because their last declared dividend was for 46 cents, this translates into 134.8% of regular distribution coverage. Their net investment income's seen continuous and sizable growth every quarter for the past year, which explains their generous dividend increases. One concern I have is their NAV has been decreasing each quarter, which is something that most business development companies have been seeing in our high interest rate environment, but Trinity's has been decreasing at a higher rate than what I've typically seen. But for the time being, it's had no impact at all on their rising income. Their current portfolio is mostly made up of floating rate loans, which they've been increasing over the past year. This helps explain their increasing net interest income given how high interest rates currently are. On the right, you can see that most of their portfolio is made up of various types of loans, with 22.5% being in equipment financing. And then there's also this third category, which is their equity investments and their warrants. There are some BDCs that have sizable investments in warrants, but they usually don't represent a major part of their portfolio. For Trinity Capital, it's been decreasing a lot for them over the past few quarters. Warrants are a type of alternative investment that give the holder the right to buy the shares of a company for a specified price during a specified period of time. Companies can issue warrants in order to raise capital for various purchases or acquisitions. By nature, warrants are generally viewed as being pretty risky holdings. I'm assuming the fact that Trinity invests in startups that these kinds of businesses use them as a means of help speeding up growth. I'm not an expert on derivatives, so it's really out of my scope of knowledge. I do know that Triple Point Venture Growth, which is another BDC that invests in startups, also has a really sizable warrant portfolio. The largest sector in their portfolio is made up of green technology companies, followed by finance and insurance, and then food and agricultural technologies. Most of their investments are made in West Coast companies, which really isn't too big of a surprise. And just like their peers, Trinity Capital's stock fell by a pretty sizable amount after the announcement of Silicon Valley Bank shutting down. But unlike Hercules Capital and Triple Point, Trinity stock has actually recovered much better since this event. But with all the good news this company's been seeing, I think we also need to consider a few things. As I mentioned earlier, Trinity Capital specializes in venture debt, which involves lending money to high-risk startups. These companies require a lot of cash in order to get their feet off the ground, and many of them ultimately don't succeed. On page 139 of their latest 10K report, it says, as of December 31st, 2022, loans to 2 portfolio companies and equipment financings to 2 portfolio companies were on non-accrual status, which is a total of approximately $49.2 million, and for a total fair value of approximately $17.8 million, or 1.7% of the fair value of the company's debt investment portfolio. Non-accrual means that Trinity isn't earning any income from these loans due to the companies that they lended to not being able to pay interest. So with just 1.7% of their total portfolio being on non-accrual, that's actually pretty good in terms of a BDC, and so far we haven't seen this tidal wave of loan defaults. But there is one unique aspect about Trinity Capital's portfolio. One of the biggest reasons why business development companies exist in the first place is to provide smaller companies with financing who either can't get funding from more traditional sources like a bank or from going public, or they have some other unique situation going on. This can make it hard to analyze the performance of what BDCs invest in because they usually invest in companies that aren't public and therefore don't publish financial statements. But with Trinity Capital, a lot of their investments are in companies that are publicly traded. Therefore, we can look some of them up and see how these companies they're invested in are performing. So I just wanted to look up some of the biggest companies they're invested in to see how they've been performing. One company they provided a lot of equipment financing for is in a company called Backblaze, which is a cloud storage company. Just looking at their income statement, we can see this company's been reporting negative net income since their IPO every single quarter. Lucid Motors is another company that they're currently invested in. We can also see negative net income every single quarter since their IPO for this company too. HUD-8 Mining Company, which is a cryptocurrency mining company, is another one of Trinity Capital's investments. This BDC does invest in cryptocurrency companies, by the way, which is a sector that Hercules Capital won't even touch due to how risky it is. But this is another company that's also been reporting some pretty bad financial results, which just recently got a whole lot worse. Then there's also Greenlight Biosciences, which is a biotech company. Again, this is another one of Trinity Capital's holdings that's been reporting some pretty awful earnings in their financials. I could keep digging into their investments, but based upon what I've seen so far, I'm really concerned about the state of a lot of the companies that Trinity invests in. I know it can take years for startups to actually become profitable, but if the economy keeps getting worse, then I am concerned about the long-term performance of this stock. Remember, Trinity Capital's only been around for 2 years. They just don't have the track record of the more established companies like Ares Capital, Hercules Capital, Main Street Capital, or even Owl Rock Capital have. Ultimately, I think Trinity Capital will continue to be a good performer in the short term, but how long that'll actually last, especially if the economy gets worse, is going to be anyone's guess. For serious income investors, it's my opinion that if you want to invest heavily into BDCs, that you go with stocks that have long-established track records into more of the so-called boring types of businesses. Trinity Capital, despite their good performance over the last 2 years, I think should be viewed as a much higher risk type of company. But be sure to perform your own research and come to your own conclusion before investing. With that being said, thank you all so much for watching today's video, and until next time, take care.